Hi everyone, welcome back to Bayrich. It's me, Vinod, wishing you a wonderful evening. I hope your day was productive. I managed to pick up some Karnataka Bank stock today thanks to the correction we saw, thanks to the results. The results were not spectacular, and Mr. Market decided to give it a beating. And I said thank you very much. And I went having my snacks and tiffin. I did share something in the LinkedIn and the various other groups which I'm there, including the Instagram, about the paradox of choice. It's something that's been spoken about in different formats with different influencers and commentators. And I thought it's relevant for us too, because we have a problem of choice, the paradox of choice in value investing too. Every day we focus on which stock to buy, what not to buy, and if we tend to populate ourselves with the entire breadth and width of the market and look at all the dimensionalities of it, we will get frozen and we'll find it very hard to make a choice. And that frustration will finally lead us to saying not investing at all, because we'll find it overwhelming. So the advantage of creating a list, like we have our Patas list, if you want to call it that, or whatever list you'd like to call it, your stock list, is essential so that you can stay focused and you get this incremental investing done. In this age of AI and social media and all other distractions, it's getting harder and harder to focus. And we have to find ways to mitigate distraction and stay focused on what we're trying to do. Wealth building is easy in some ways and it's hard in some ways. The easy part is the plan. We have a list of stocks and you just have to be consistent, and you just have to put in small amounts every day consistently and you grow the wealth. The hard part is staying focused and being present and repeatedly doing the same process over and over again, day in and day out, every time the market gives you an opportunity. Sadly, that is where this distraction of social media and the life around us and AI, everything tries to constantly derail us from this by constant distractions. Be it the phone, be it a watch, be it any kind of notification, it can set you on a tailspin. So try and be aware of this and try to stay focused on your long-term plan, where you're going and how you plan to get there, than focusing on short-term news cycles and worrying about smaller things. Yesterday I spoke about Merck in the pharmaceutical sector. Today I'm going to the other side of the field. I wanted to talk about another company which was founded in the US in 1978 in Georgia. It was a one-stop shop kind of an idea for do-it-yourself people like you and me who want to create wealth by ourselves. Us retail investors are DIYers of investing. We don't want to go to mutual fund houses. We don't want to have anyone manage our funds. We believe we can wing it and figure it out ourselves by studying here and there and increasing our knowledge. That was the same principle this company was founded on. Its first store appeared in Atlanta, Georgia in 1979. Then they went into an IPO in 1981 before entering the Fortune 500 in 84. Through the 1990s, they did expansions going into Mexico. In the 2010s, they entered the e-commerce space. And the pandemic, actually, funnily enough, was a great time for them. And it was a boom market for them. And they managed to do very well during the pandemic. I'm talking about Home Depot. Home Depot is a one-stop shop warehouse where anyone who wants to do anything related to creating physically, be it carpentry, something related to hobbies or home projects or gardening, they can go and pick up a product or find solutions there which can help them create these ideas. They are the OGs, as they say, of before we find these 5-minute reels which run in Instagram, on YouTube. We find them, these 5-minute ideas which pop up where you can do this. Home Depot was way back. They found this out long ago. So I thought we'll talk about them and see if that company is of something of value, because it's there in the S&P 500. Should you be looking at this company? Well, quarter one of this year for them, the revenues were up from year on year by 14%. That's around $40 billion. The EPS is standing at 3.13, which is better than the estimate. That is for the quarter, of course, not for the entire year. And sales domestically and globally has marginally gone up from the last year. And net income year on year is up at $3 billion. As far as the guidance for the rest of the years is concerned, they think sales growth should be there, improvement in operating margins, and there are some new stores in the pipeline. financial health-wise, over the last few decades, there's been consistent and stable in earnings and growth. Their free cash flow for the last 3 years has been 68 of earnings before interest and tax. Debt to equity ratio is what will blow your mind. They are at 770%. That means they have a very high borrowing compared to their equity. And that is where the problem is. The interest coverage is okay. They've been managing their debt well. It's at 10.2 times. But the red flag is, of course, the high level of debt and the high interest rate which the American domestic market is at. The Feds have raised the interest rate. Home Depot, of course, took a lot of the loans when interest rates were much lower. During the pandemic onwards, if you see the charts, I'll ask Rupesh to put it on the screen, you see how debt has been growing for them consistently. And this is where the problem is. In terms of valuations, the price to earnings is 25, which is below the peers, and the price to earnings against growth, which is a PEG ratio, has put them at 4.3, which is very expensive in terms of the growth rate which they are at. The price to books is at 15, which is also high, but it shows most investors have high degree of confidence in the company, and the dividend yield is at 2.47%. So I personally think this company is very expensive, and you should be very wary of entering it at this kind of price, in terms of just price. Then, of course, there is the debt worry. The debt is something to be concerned about because the amount of debt which they have is so voluminously huge. And with the interest rate cycles staying where they are going to, and the Fed doesn't seem to be in any mood to lower the interest rate, the softening of inflation in the US may be a blip. Maybe it's not a blip. We'll have to wait and watch. But the Fed has no interest in doing anything as far as interest rates are concerned. And the inflation was supposed to be fanned by the tariff wars with China, and Trump has blinked over there, and they seem to have taken a U-turn. So we have to wait and watch in terms of what happens to interest rates. And that has a direct implication to Home Depot. The PE, as far as it's concerned, the 5-year median for Home Depot has always been around 21. Right now it's at 25. So even there, in those terms, it's expensive, right? Earnings is going to be under pressure going forward, like I said. And if you do the discounted cash flow analysis for this with intrinsic value, this stock should be priced around $260 for value investors to look at it, is what calculations are saying. The price of the current stock is at $372 a piece. So I would say this is an expensive stock to buy for a value investor. So what do you think about Home Depot? Do you think its peers like Lowell is something you'd rather look at, or would you look at Home Depot? I'm curious to know, those of you who are looking at American markets, have you heard of Home Depot? I'm sure you have. What is your opinion of Home Depot? Is it expensive? Is it cheap? Put it down. I would like to read it. And what other American companies are there on your list which are in the same spectrum as Home Depot, which you have been considering, which you think at great price to earnings, and the debt is lower enough for you to think it's a great buy? I want to hear about that. If I find something interesting, I might bring it here to the audience and talk about it more. Thanks for watching me on Be Rich today. I hope you had a wonderful day and you had a wonderful evening. Nothing else more to say. Tomorrow I'll come back with another piece of treat from the American market. Like I said, I'm talking more about Indian stocks on Instagram, on the Instagram channel. If you're interested on Indian stocks only, catch me there. And I'll talk about more Indian stocks there and what I'm doing in terms of my own Tiffin Coffee investing in Indian markets. This is purely for American stocks in American markets and global markets. I'll try and pull in Shashwat maybe in the weekend if he's free and try to have another conversation with him. Nothing else more to say other than saying good night and see you tomorrow. Bye.